Hello, everyone. Welcome to the stock-specific class here for Friday, April the 9th. Just a quick announcement before we get started. I am going to be doing the market update next week on Monday, the April 12th. I'm not going to be able to do it on Tuesday, the normal Tuesday, so the schedule's off a little bit this last week, but just make a note of that. If for some reason you forget or you miss it, the recording will be there on Tuesday, so you'll be able to view it. But I'll be doing that market update on Monday, April the 12th. So real quickly here before we get into specific stocks, by the way, the training I'm going to do today is on order types. Now, many of you that have already been trading, these will probably already be familiar to you. This is probably geared a little bit more towards people that are just getting started, have very little knowledge of what they're doing, or maybe they have used a couple of trade types of orders, but they don't know how to use other types, and it might be able to help them enhance their trading capacity by being able to learn about some of these different order types they could use. Now, real quickly, as far as the direction alerts, we're still dealing with a tired market. You've got sentiment above momentum and momentum above breadth, but the market keeps grinding higher. I really thought that we'd start to see it sell off this week. That's what I talked about earlier in the week. It's showing signs that it's going higher, but it's really lagging. The volume has been extremely light. We'll take a look at that here in just a second. Like I said, we're seeing the tired indicators here on the chart showing the tired market. So, and now when you move down, you're starting to see in the extreme range. You got momentum in the extreme range. You've got breadth in the extreme range, and you've got sentiment, which is just almost in the extreme range there. But it's actually fairly rare to see sentiment get all the way into the extreme range. At least we haven't seen it there for quite a while. You can still get some market pullbacks without it reaching the extreme range. But now, obviously, these could still move a little bit further to the right side of those boxes. But it wouldn't take much to do that. I mean, another decent up day or two, and you're right there. So, although we didn't see a pullback this week, next week might be the week then. Now, but one other thing I do want to point out, I think I mentioned this last week as well, that in order for a market to kind of alleviate the overbought condition, it doesn't necessarily have to sell off or pull back. It could move sideways. We don't like it when it moves sideways because nobody really makes money. Well, unless there's strategies you can make money in a sideways market, but usually you end up working twice as hard for half as much money, has been my experience. But you could move sideways to kind of consolidate a little bit and alleviate that overbought condition before moving higher. So that's definitely a possibility. So we'll see. We'll see if we get a sell-off here. I think if it starts to sell off, it'll probably be pretty sharp. I would expect, maybe like an 8 to 10% pullback from all that we've rallied up over the last several months. It probably would need to correct that, or we move sideways for several months. And that'd be kind of a boring market. It'd be boring in the updates, but the market doesn't always do what we want it to do. So we'll see what happens there. But if we take a look at the sentiment reading here, it did get extreme, and it's kind of backed a little bit below that extreme level. Wouldn't take much to get back above there again. In fact, I would be surprised with today's rally that it pushes it back above there. If we take a look at the charts here real quick, you can see we're just kind of keep grinding higher. A couple of key things I'm looking for, though. So S&P's moved higher, Dow's moved higher, should close a new all-time high today as well. NASDAQ, again, I've been talking about, I went on record to say that I didn't believe we'd reach a new all-time high anytime soon on the Nasdaq 100. We're right up against it there. But like I said, with the market, really, you can see it's up here in the extreme reversal risk range up here. It still might not get there. I still might end up being right, although it I was expecting a little more of a reversal back in here around that 330 area, and it kind of pushed back through there. So went a little bit further than I was kind of expecting. But there again, that's kind of what's happened this week. It's just kind of stretched a little bit further. But if you think of it, the market, when you talk about it getting stretched, if you think of it like a rubber band, that rubber band is getting really, really extended, and it's likely to kind of snap back in any moment. That's usually the mental image I get when I think about a stretch market, is that rubber band stretching out. Could it stretch a little bit longer? Yeah, but usually it's going to snap back pretty hard when it does finally go. And I think really this market, the way it's setting up right now, to me, it's just waiting for a trigger. Now, I don't know what that is, and it really doesn't have to be anything major. It doesn't have to be some major negative news that could trigger something. A lot of times it isn't. A lot of times it's something that's negative, but not, you wouldn't think of being catastrophic or what have you. And the market is, starts selling off in a big way. And that's what confuses a lot of people a lot of times, is that they're like, well, that news is bad, but not that bad. But you get in these conditions, and if you think of it from a human nature standpoint, you can if you're a seasoned trader, you're recognizing the same things I'm pointing out. I'm not telling you anything different than what you would already know. So if you go ask any other professional trader out there right now, that at least a technical trader, one that looks at the charts, they're going to tell you the same thing I'm telling you, that, hey, all the signals are pointing to a market that's extended, that's stretched, that should be pulling back. Okay. But it hasn't yet. And so again, if you're a trader, like, boy, it keeps going higher. I don't want to short it yet. I don't see a reason to start getting aggressive, to start selling yet. And so that's why you're seeing these condensed volumes. There's no volume in the market right now because there's not a lot of people aggressively buying, and there's not a lot of people aggressively selling yet. They're just kind of waiting. Everyone's kind of waiting for something to happen. Okay. Now, we talk about this in Elliott Wave all the time, that crowd behavior. Well, what is crowd behavior? Crowd behavior are things when you think you're doing something individually, when actually you're behaving like everybody else in the crowd. In other words, I'm sitting here with my trade saying, I don't want to buy anymore right now because we're stretched and we're probably due for a pullback. I don't see a reason to sell or short the market yet, because who knows, the market could grind higher and I could get killed being short. So I'm going to sit tight. That's what I'm doing personally. Okay. Now, I individually think it's only me making this decision. I'm the one I'm the only one doing this. When in reality, there are thousands and thousands and thousands of other traders that are thinking and doing the exact same thing. And that's what's being reflected in these charts. That's what's being reflected in the volume. It's being reflected in the fact that we're going higher, but we're just kind of grinding higher. And so what are we all waiting for? We're waiting for a reason. I'm waiting for a reason to sell. And if something comes out, now again, the difference is that me personally, I can't cause the market to drop. If I see a reason to sell and I start selling, my selling is not going to be big enough to move the market. Okay, so it really comes down to the big boys, the big institutional traders. What's going to trigger their selling? And I don't know what that is. But whenever you hear me talk about a trigger, that's what I'm saying, is that we're just kind of waiting for a reason to sell, and not us, but the big institutional traders. And it's just impossible to know what their specific reason would be. But I think we're kind of just gearing up for that, where we're right there. It's like the fire is there with the gasoline on it, and it's just waiting for that match to light it, and so we'll see. We'll see if that ends up being the case. I could be wrong about that, and maybe we break out and go higher for 3 more months. But the conditions right now, and I've been through this so many times over my 20 plus years of doing this, that it really is a pretty high probability that we're going to get some sort of pullback here pretty soon. And it could be that maybe the NASDAQ 100 breaks out, draws people in because they weren't expecting that, like I wasn't expecting that, and then it crushes them. Because one thing the market likes to do is it likes to hurt the most people it possibly can. So if they can get too many people to one side of the trade, it likes to crush them at that point. So that's definitely a possibility. The market, as far as sentiment is concerned, is extremely bullish. There's so many people out there that are of the belief that the market is going higher, and that's usually what you see at the top. The Russell 2000 is just lagging completely, and I talked about early in the week that maybe we rally up to this area right here, but it's not looking like it's even going to get up to that area. It got close, and then this whole week it's just been kind of moving lower. And the small caps, because they have tended to be the leadership of this rally, it's looking like a little bit of a leading indicator here that maybe it's kind of leading the way down, possibly leading the way down. It's definitely showing that because these tend to be the smaller companies, it's showing that that there's a risk-off environment right now. That most of the money is going into more of the stable companies, less into the riskier companies. But the big institutional traders make most of their money in these riskier companies when they do well. But like many of them did in the late part of last year. And so when you start to see that the big institutional traders are getting out of the riskier trades and they're going into the safer trades, that's usually what you see at the top too, that, you see that kind of sector rotation taking place. And that's why I pay a lot of attention to the Russell 2000 compared to the other indexes, is to see if I can see. Remember, the whole point of what we're doing here is to try to read what the big institutional traders are doing. That's if you're a chart reader or technical trader, you're just trying to see what they're doing so you can follow along. They're not going to tell you what they're going to do, but they leave little clues. And these are all things I'm teaching each week, are little clues to figure out what those big institutional traders are thinking and doing. When we look at the VIX, why do we look at the VIX? Because the VIX tells you whether those institutional traders are hedging or not, and if they're hedging, why are they hedging? Do they believe it's going to be a bigger sell-off than normal or something like that? So small caps, they tend to go into small caps when they're really confident the market's going to go higher, and those stocks are going to outperform because they're going to make a lot of money on those. Well, if I see the Russell 2000 outperforming the other indexes, then it tells me that those big institutional traders are feeling pretty good about the conditions. When I see it lagging like this, it tells me that they're a little bit worried about the future conditions, and they might be itching to sell a little bit or take profits off the table. So, all right, so that's the environment we're in as we're looking at some individual stocks to get into. Again, I would, as I have for about a week now, as we've gone through some of these individual stocks, really wait for that confirmation, wait for it to go back to a buy signal, or even just be very selective, just because you don't want to be buying in too much at the top if it is going to pull back. All right, so let's look at our sectors here. And I'd mentioned one on Tuesday under business services. I still like it. And it was this Futu Holdings, FUTU, 98 strength rank, hold signal 98 strength rank. And again, what I'd like, let's switch this to signals here. What I liked about this pattern was it looked like it could be forming an inverse head and shoulders right here. Now, I also mentioned that it might it might have a little bit more back and forth, meaning it could have this move down, this move up, and another move down. So if the market sells off, it could come all the way back down. Usually on a head and shoulders pattern, the right and left shoulders end about the same spot. So this would take into account if we do have a little bit of a market sell-off, this could pull back into this area here. But again, we're waiting for it to go back to a buy signal anyway. Here's your neckline, but if it breaks out above the neckline in the next few days, it's probably, you would assume there's a good probability that it's going to work its way higher. At least that's how you kind of trade those inverse head and shoulders patterns. Or now, if it does break above that neckline, again, the rule of thumb with the inverse head and shoulders patterns, it will typically move up about the same distance as the base of the head to in this case, the bottom of the head right here, because it's an upside down head and shoulders. So the neckline to the bottom of the head, project that distance upward. And it gives you kind of a rule of thumb target area. Now, we do have a previous all-time high right here, so I would probably assume that it wouldn't get that same distance without consolidating a little bit. In other words, I think it could run to that previous high, and then maybe it pulls back again and then breaks out. But if it breaks out of that, you could take this whole distance and project it upward as a target area. Now, it'd be a longer-term target area. It doesn't mean it's going to get there right away, but there's a good chance it's going to work its way up to that general area. So I like that one. It's getting close to going back to a buy signal, but I would probably throw in there as extra confirmation if I was going to buy, to make sure it broke out of that neckline. So got up above here, just because of the conditions we're in and the pattern itself. And we're so close, it'd be, it wouldn't hurt you just to wait a little bit for a little bit stronger confirmation. All right, also under sectors, industrial products, under the holds. Here's ALCOA. It's a 90 strength rank, but you can see there's only 198 strength rank. I don't even know if that's a real stock. These are 1 penny stocks. I don't know if that's completely accurate there. So you're not seeing a lot of high strength rank in the hold section here. So it's kind of one of those relative things. Some of these sectors, when you do this long enough, you'll notice that they're not always going to be. They can still be great patterns, but they might not always reach that 98 strength rank that you like to look for. But again, I think the important thing is you're still can find stocks that are strong stocks within those sectors. And ALCOA has a 90 strength rank. That's about as low as I'd like to go. I'd always want my strength rank to be in the 90s if possible. It'd have to be a really nice chart pattern for me to go lower than that. But ALCOA here, you can see it's been in a nice uptrend, larger uptrend. Even right through here, I draw a trend line up there. Every time it's kind of hit that line, we're right at it right now. It's tended to bounce off of it. Now, it's eventually it's not going to bounce off of that, but that's why we wait for that confirmation. If it breaks that trend line, I'd probably want to maybe stay away from it for a little bit, or not consider it. But if it holds that, it has gone to a higher high right here. That could be a higher low if it holds that trend line. And if it goes back to that buy signal, it should go to another higher high. So it should have a strong chance to move higher there. So I like that one. That one's a little ways away from going back to that hold signal or that buy signal. But we probably want that in these market conditions to avoid buying in at the very top right once it starts selling off. Let's do one more here. Again, there's just not a lot that I really like. So I know this is a stock specific class, but I don't want to encourage too much buying in these conditions right now. But oils and energy down here, right at the very top is a 100 strength rank. This Whiting Petroleum Corp, WLL is ticker symbol. Oh, it looks like it's gone to a buy signal today. But it has this consolidation through here, had a nice run up here, consolidated through here, and then went up higher. Whenever you see a stock moving sideways, you want to pay attention to the direction it was moving in before it moved sideways. That's where it's more likely to go after it's done moving sideways. Now, having said that, there is sometimes when you get these sideways moves like this, you can sometimes get a dip below it. You get a sharp sell up below it, and then it takes off again. It's almost like when you move sideways, it's showing you that there's indecision. Buyers don't want to buy, sellers don't want to sell, and that's why you get locked in these sideways ranges for a long period of time. Is just there's just nothing that's triggering a reason to do anything. It's everyone's waiting around, right? What can change that is a break out of that above that range that could trigger the buyers to jump in and push it higher. Another thing that can trigger buying is so breaking out higher could trigger buying because people say, okay, someone's believing the stock should be ready to go again, and we're going to buy that breakout. That's why we like breakouts. But another thing that can trigger buying is a cheaper price, right? Maybe the reason why this isn't going higher is people want to see it lower first. And again, this is weird because it's like it could go lower for 2 days and you start buying and it could be right back at the price it was 2 days ago as the stock runs back up again, and still that'll trigger buying to go higher again. It's just one of those weird psychological things. Let me show you an example of what I'm talking about. That can trigger more buying. Back here, you had that same thing, sideways move. People didn't really want to buy it. People didn't want to sell it. And then it broke that sideways range and it dropped down low enough to where now people wanted to buy it. They just wanted a little bit lower price to feel comfortable buying it. And then look what happened. Within a few days, it's back in that range again, but this time it's taken off. It's launching. What changed? What caused so many people that didn't want to buy right here? They want to buy down here, but when it's back in this range again, they still want to buy. It's one of those weird things, but that can happen sometimes out of real side, and it usually happens when it's moving really sideways within a range. So when I taught that thing about whenever you see a stock moving sideways, you want to pay attention to the direction it was moving in before it moved sideways. That's where it's likely to go after it's done moving sideways. That's still true. That probability is still true, but on those real flat sideways, usually real extended ones, you can really notice them. Don't be surprised sometimes if you get a sharp dip and then it takes off. Obviously, if it just moves up and breaks out, it could take off. And it's possible that it could drop and keep dropping, but usually tops don't form. I used to call these volcano tops because most tops, when stocks reverse, they tend to reverse sharply or fairly sharply, meaning you're stair stepping up and then you get kind of that pointy top and you start stair stepping down. That's typically how most reversals, and there's variations of this. It's not always that pointy at the top, but typically it tends to be that way. Very rarely do you see a stock stair step up and then move sideways for a long period of time and then come all the way back down. I used to call these volcano tops because they look like the top of a volcano. And what you should understand about volcano tops is they're extremely rare. Very rarely does that happen. And so usually when you see a sideways moving trend like that and it wasn't a nice strong uptrend, usually it's going to end up going higher. Now, it doesn't have to go that much higher. You could be in this sideways trend and barely break out again and then reverse, and there you go. You got your pointy top right there, right? But usually you're going to break out of that sideways range and go higher at some point. Sometimes, though, the reasons, and again, it's important to just understand why it's going sideways. What's causing it to go sideways? Well, it's that indecision. It's buyers aren't too excited to buy right here. Sellers aren't excited to sell right here, and everyone's waiting. It's just kind of a waiting game. And that can last a long time. That's why I don't necessarily like to buy into these long sideways moves, because I could be in there for 3 more months before it does anything. I either want to wait for it to break out of that sideways range to the upside, or a lot of times I'll wait for that sharp sell-off dip, like it did right here. Wait till that's kind of done going. It starts moving back up again, and then that could be the trigger that causes it to break out and go higher. So anyway, so even though we're going back to a buy signal right here, that's something you could consider on this. You can look at the top of the range, the bottom of the range. If it can break out above the top of that range, that might be a better entry point in these market conditions to wait for that breakout, because it could stay sideways like this for a couple more months or so, possibly. But or it could have that, if the market sells off, have that sharp sell off that then triggers the buying. You know, what the reason why I keep hoping for a market sell off is for that reason. I think we're stagnating because people are just don't want to pay those higher prices. Okay, and because I don't. I want to see some of these charts come down a little bit to where they're a little bit more attractive. And so what I expect is a sharp sell-off in the market, maybe create a little bit of fear and uncertainty as to how things are going to shape up. And then the buying, I think, is going to really move us forward again. And it'll be a great time to buy and a great trend to ride as it moves back higher again. So we'll see. We'll see what happens. All right, but those are kind of a couple there that you can kind of consider or look at, and then just, you know, you can consider my analysis of the market conditions. Maybe wait for a breakout as a little extra confirmation signal there on some of these before considering them. All right, let's move into the training for today, and let me do something here real quick. To log back into my broker account or my demo account. All right. What we're going to talk about today are the different order types. And as I mentioned at the beginning of the class, many of these are pretty basic, and if you've been trading for a while, you probably already know about them. But there are some of you that are just getting started that maybe you know a few of them, but you don't know the different ways you can use these different orders, and it can expand your trading ability. The first one, so there's a market order, and every broker out there should have all of these. Now, there are more advanced systems that have different expansions of these types of orders, more complex. And in a lot of cases, not usually necessary. Some of the types of orders you can do nowadays are just, I think people like to use them just because they're complex, and they, it makes them feel real smart that they can do an order that most people don't know how to do. They can call themselves an advanced trader because of it or something like that, but it doesn't necessarily mean that it makes them more money all the time. So sometimes you can kind of overdo it with your complexity. But every broker out there should have these basic types of orders that you can use. Now, as far as individually where to find them or where they are on your platform and all that kind of stuff, it might be something you might have to check with your broker, just because I can't cover everybody's different platform in these trainings. But the basic market order, a limit order, a stop limit order, and a trailing stop. And I want to just kind of briefly explain what each order can do. And this is educational too, because even if you're aware of these orders, you might not know the risks of some of these orders because you don't know exactly what's going on. And so that's another benefit of doing this. But start with a market order. It's the most basic order. It's usually at the top of every order platform. This order lets you buy or sell at the current market price of the stock or the option that you're looking to buy. So whatever that current quote is whatever and usually it's the last order, meaning the last order that a trade went through. Now, I think that's important to understand because you have an ask price. That's what you could buy the stock at. So let's say you have a $37 ask price. That's what you can buy it at, and you might have a $36 bid price. That's what you can sell at. You buy at the ask, you sell at the bid. Those are quotes. Those are telling you what the current quotes are. Okay. Now, the last order that actually went through, where it was actually someone actually bought it or somebody actually sold it, maybe the last order was at 35. So as the stock went up, the ask price went up and the bid price went up, but this is the broker saying, hey, anyone that wants to buy the stock, you can buy it at 37. That's what it's worth right now. It's at 37. But the last order transaction that actually went through could have been at 35. Now, again, it's kind of like let's say you're at a store and you're looking at something on the shelf. Well, the shelf price is $37. Let's say, okay, the item you want to buy is $37, and you take that item to the register and you go through the register and you ended up buying it at $37. Well, as you buy that stock at $37 and you go through the register, that price is, you bought it at $37. That was the last price that went through. Well, let's say as soon as you went through there, the store decided to raise the price on that item because they felt like it was worth more. Okay. There's a lot of people buying this item. Maybe we can get a little bit more money out of this. So they raise the price to 38. Well, the next person that grabs that off the shelf, it hasn't gone to the register yet. The actual last price went through was at 37. They were quoted 38 as they pulled it off the shelf. Okay, that was the last price. Now it doesn't mean that this person isn't going to have to buy it at 38. Because if they go through the register, that price went up. They're going to buy it at 38. But this last price becomes important for these types of orders because it's what it's what they get triggered at. Okay, and this will make a little bit more sense as we get into the specifics of these orders. Okay, so a market order is going to let you buy or sell at whatever the current price of that stock is. So using that same store example, let's say that when I pulled it off the shelf, I was quoted $37. Well, if I use a market order, what I'm basically telling the brokers, I want to buy it at whatever the current price is. Here's my checkbook. You write in whatever the current price is, and I'll buy it at that price. I know that sounds kind of crazy, but it's kind of what you're doing. Because here's what could happen. You take it off the shelf at $37. You go up to the check stand, but as you go up to the check stand, that price on the shelf just changed to $39. Because the store owner thought that item was worth more now, and he bumped it up to $39. Well, guess what? As you go through the register, you're not paying $37, which you saw on the shelf. You gave the store your blank checkbook and say, write in whatever the current price is, and I'm going to buy it at that price. Well, the current price went up as you were walking to the check stand, and it's $39, and you just paid that higher price. Now, the opposite could happen too. You could have seen $37 on the shelf, and as you're walking up to the check stand, the price could have gone down to $36, and you said you want to buy it at whatever the current price is. Well, the current price is $36, and you bought it at $36. Now, a market order, the reason why people use a market order is that it's very quick and easy. Because you're willing to pay whatever price it is, that broker's willing to sell it to you whatever price he wants to sell it to you at, and the transaction happens very quickly. You don't have to haggle or anything, or get filled on part of your order or something like that. Okay. The danger, and most of the time in a regular moving market, it's not going to be that big of a deal. But you better understand what the risk is. That price you saw at 37 as you were filling out that order, that's what you're assuming you're going to buy at. You could end up buying it $45 if for some reason while you're placing your order, some breaking news came out and it spiked that price up immediately. That's a huge difference, and you could be shocked. And so it's a dangerous order, especially in a fast-moving market. If you've got a market especially when there's like a lot of fear, you bought that stock at $37, and you could use a sell order as a market order. You could put your sell order as a market order. Let's say that stock just starts to tank. Everything's tanking in the market. There's fear everywhere. And that stock dropped down to $35 in 5 seconds, and you're freaking out because $2 is a lot. So you put a market order to get in or to get out. That thing is moving so fast that by the time you get filled, that thing could be down to $30 when you finally get filled. Now, it is the fastest way to get out of a trade, but this is what causes those big market crashes, is because everyone's trying to get out and everyone's in a panic, so they're trying to get out immediately, and so they're using these market orders, and these market makers don't know how far things are going to drop, and so they're dropping prices, the sell side, the bid price, they're dropping it way down quickly to make sure they don't get burned. And that's what can happen. It just can move so far, and the opposite can be true where it's moving up, breaking. So I would recommend that if you're buying something on breaking news or anything like that, don't use a market order, because you're probably going to get filled at a much higher or lower price if it's a sell than you were expecting. It's just very dangerous. Not a good habit to get into. And again, just think of it as you're handing your checkbook to that market maker saying, put in whatever price you want to put in, and would you ever do that? And most of you would say, no, I'd never do that, especially since he's not going to give you the best price. He's going to give you the best price for him, not for you. Okay. A limit order, this is a better way to enter your trade. This order lets you buy or sell the stock or the option at a specific price or better. So let's say if I get quoted at $37, that's the ask price, and I put in my order form, I want to buy it at a limit order of 37. What you're telling the floor trader is, I want to buy that stock at $37 or any price that's better than that. So if when I'm placing my order, that stock jumped up to $38 in the process, and usually it's not going to be jumping by dollars, it'll be by cents, but still, I'm just trying to make the example kind of easier to understand. It's not going to fill your order. You're not going to pay that higher price because you set a limit on what they could charge you for it. Now, especially when you're trying to get into big positions, and this happens a lot with option trades because the prices on options are cheaper, you can buy a lot of contracts which control a lot of shares. But let's say I'm trying to buy 50 contracts of an option. Well, I set a limit order at $5 or something like that. Well, the market maker might sell me 10 contracts at $5, but because I'm trying to buy so many contracts, he's going to boost the price up. He wants to boost the price up. So the price goes up to $6. I'm not going to get filled on the rest of those contracts because I set that limit price. I said it's got to be at $5 or better. So what can happen then is you're going to have to wait. You're going to have to wait until that price sags back down again. Maybe there's no other people buying options there, so the price comes back down to $5. It triggers another 10 contracts, and then the price bumps up again. So it might take you a little bit longer to get into the trade because you're trying to buy more than the market can take right now. Does that make sense? as you want to buy more, guess what? The prices are going to go up. And if you have that limit price, you're not going to be buying it, but you have to wait for it to kind of come back down again. And so it can take you sometimes a little bit longer to get into a trade, but you're getting in at the price level you want to get into. Because otherwise, if you're trying to get into a price that's higher than the market can take, let's say you try to buy those 50 contracts at $5, you'll get filled on 10 contracts at 5, it moved up to 6. Especially if you left that in as a market order, you might get filled on another 10 contracts at 6. The price moved up to 7, you get filled on another 10 contracts at 7. In other words, you're buying at a higher price because you're the one jacking up the price. And as soon as you get in on all your contracts, what's going to happen? There's no other buyers out there, so the price is going to fall right back down to $5 again. You jack the price up on yourself. So by using a limit order, you're specifying a specific price or better. Now, if you set that limit order at $37, and as your order is going to the floor, that price dropped down to 36. Guess what you get filled at? You get filled at $36. That's what you end up paying for the stock there. Why? Because you said you wanted to get filled at $37, a specific price, or better. And 36 was a better price for you. And so you get it filled at that better price. So this is the recommended order type for entering or exiting your trades, and the same would be for getting out. If I bought the stock at $37 and I got filled on it, I'm in my trade, and there's a resistance area at $45 that I want to get out at because I don't think it's going to break through that resistance area right away, but I want to get out at $40. I could put a limit order to sell. See, we can use a limit order for buying or selling. I could put a limit order to sell that stock at $40. And you say, well, wait a second, Jerry, if I do that, what if the stock moved up to $38? Wouldn't I get stopped out, and wouldn't I get out of that trade immediately? Wouldn't I sell immediately because that's a lower price? No, when you're remember, or better means better. Is that a better price than 40? Is 38 a better price than 40? No. When you're selling, better would be higher. So if I put a sell order to sell that stock at $40, a limit order to sell that stock at $40, it's saying I want to sell at $40 or better, or anything above that. So if let's say the next day some good news came out and this stock jumped up and it gapped up and it opened at $43, it's going to trigger my order because I said I want to get out at $40 or better. 43 is a better price. I got out at more money. As long as it's moving up to $40, it's not going to trigger that price. I'm not getting out. So people like to do this sometimes because they can put it on autopilot a little bit, where it's like I'm gonna buy that stock at $30, and I don't want to get out too, be too fearful that I had too much of a gain. I'm going to take my profit too early. So I'm just going to put a limit order to get out at 40 and then try to forget about it. So it can let it get there. I'm not going to get my emotions in the back and forth of the daily movements. And I can know that I could get out at that $40 or a better price. If it gaps up above it, that's even better for me. So that's usually what I would recommend for entering or exiting trades, is to use that limit order. All right. Stop order. This order lets you set a price at which you can stop out of a trade. Now, what's important about a stop order is that this price is a trigger price. The order that goes to the floor is going to be a market order. Okay, so if I bought the stock at $40, So let's say, let's draw a chart here because this will kind of illustrate. You have a little bit of a corrective pattern right here that's starting to go back up again. And I'm going to buy the stock right here at $40. And I see there's a support level. Here's where it bounced off that level right there. And let's say that's at $37. And I feel like if that stock, I'm getting it at 40 because I think this thing is going to go higher, right? I'm thinking this trend is going to continue to go up. But if it doesn't go up and it goes below this low, it's probably still going down. I want to cut my loss. I want to keep my loss short right there, or keep it from getting too big. Okay. By the way, if you're not managing your trades and using stop, if you don't know where you're going to get out of the loss, where you're going to get out of the profit, what your plan is for your trade, that's a problem. We'll have a class on that a little bit later about trading plans and different types of trading plans that you can consider. All right, so what I could do is once I got into that trade and bought the stock at $40, I could put in a stop order at $37. Okay. Now that $37 is a trigger price. What does that mean? Well, as the stock goes down, as soon as it hits $37, it's going to trigger my order, and my order is going to be a market order. We learned about market orders. You're going to get out at whatever the current market price is. So what could happen here is this stock could drop down, hit $37, trigger my market order, and if it's still, the stock is still falling, that stock might have fallen down to 36, and by the time my order gets filled, I end up getting out at 36. I end up with a little bit bigger loss, a little bit more than I was planning on. Okay, that can happen. Just be aware of that. If you're saying, well, wait a second, I set my price at 37. How am I getting out at 36? That's what happened. Was that you set it at your trigger price, and when it actually got filled, it had moved lower. And this can happen when you're in a really fast moving market, right? Things are dropping very quickly. Okay. Now, what's also important to understand about that trigger price is that trigger price is usually going to be based on the last price. Remember I talked about that earlier? The last price is the last price that a trade actually went through. So what could have happened here is that stock was at $37.50. That was the last price that a trade went through. And then it started falling again. That bid price started dropping, but there hasn't been a trade that's gone through yet. That stock has dipped down to $36. And then an order goes through. Somebody sells out at $36. Well, guess what? That was now the last price. And since that last price was below the trigger price right there, it sends out your order as a market order. And since that stock is still at $36, you get stopped out at $36. Okay. So let me show you. Let me see if I can show you this. So you can see right here, the ask price for BLNK is at $43.43. The bid price is at $43.32. And the last price, look, it just changed. The last price is at $43.37. That was the last price that the trade went through at. Okay. And you could sit there and watch these during market hours. You can see these prices change throughout the day, especially when things are moving kind of quickly. So if I wanted to buy BLNK, you select buy. I want to buy the stock and I want to buy 100 shares. I could use a market order, which I don't recommend using. Typically, it'll default to a limit order because that's the safest one to place. So I'm going to use a limit order. And usually, you could put whatever limit price you want. The problem is if I put a price that's higher than this, it's not going to work because it's going to trigger it right away. Let's say I want a little bit more confirmation on the stock and I want to get in at $44. Remember, I'm placing an order to buy that stock at $44 or better. It's currently at $43.41. As soon as I place that order, it's going to fill it immediately at $43.41, or actually it'd fill it at whatever the last price was, $43.40. Okay. So there is a way that you could actually set an order up to buy it at a higher price if you want to do that. I'll go over that in in the next class, some different variations of this. Okay. But if I want to get in usually if you want to get in right now, usually you're going to use the current ask price. In fact, a lot of brokers, you can just click on the ask price and it'll automatically fill out this order form as a limit order with that ask price. So if I clicked right here on 43.40, see it put it right in there. All right. Oh, and then, if you wanted to put in a stop order, there's a stop market order. That's what we're talking about right here, where it would trigger it and send it as a market order. You could also use a stop limit. This order lets you set a limit price at which you can stop out of a trade. That order will get you out of the trade at that limit price or better, which would be a higher price. Now, I don't recommend using a stop limit order as a stop loss. Here's why. Let's say I bought that stock at $40 and I wanted to stop out at 37. So I set that as a stop limit order. Well, the stock drops down to $37, and as soon as it hits 37, as soon as the last price is $37, it's going to trigger my stop order to sell at $37. It's a limit price of $37 or better. Remember, you're selling. So what would be a better price? Anything higher. What could be a problem there? Well, let's say it's dropping pretty quickly, hits $37, triggers your order. Your order is going to the floor, but that stock dropped down to $36. Why? While that order was going to the floor, you told the broker you want to get out at $37 or better or higher. It's not going to stop you out of the trade. This thing could plummet and you're still in it. Okay. So although there's risk in that stop order that it could get triggered and that stock could still be falling and you could have a lower price, at least you're getting out. At least you're stopping out, which you probably want to do because it's dropping down from there. So as a stop loss, I would recommend using just a regular stop order, not a stop limit order. Now, there is a way we can use a stop limit order, which I'll get into in the next class. It's more of an advanced kind of trade. And we're actually going to use it to get into a trade. All right. And then last is a trailing stop order. This order lets you set a stop trigger price that moves up as the stock moves up. Once the trigger price is hit, it sends a sell market order to the floor. You can set up a trailing stop in a dollar amount or a percentage amount. So if I bought my stock at $40, and I put my stop in at $35, but I made it a trailing stop. I want it to trail by $5, so I can put in a dollar amount on that. I want to trail the stock by $5. Let's say that stock went up to $50. My stop would be $5 below that. My stop would move up to $45. And so what you're able to do is you're able to lock in your gains. You want it to keep going higher, and want to have it go as far as it wants to go. And when it turns around, so here my stock kept moving up. Here's where I got into the trade at $40. The stock kept moving up. My trailing stop kept moving up. It went to $50, and then it dropped down, hit 45, and it stopped me out, and I got my $5 gain there. Okay, now the tricky part with trailing stops is that if you have it too close, it's going to trigger it too quickly on a little pullback, which is okay. You could always jump back in it again. But some people like to have it back a little bit wider because they want to allow for it to pull back a little bit. They want to allow it to stair step, but not get bounced out of the step, right? Now, you can also set these up as a percentage. You buy your stock at $40. I want to set up I want to stop out if it drops down, 5% or 3% or something like that. A lot of them use like a 3% or trailing stop. And so if that stock drops down 3% off its high, it'll stop you out of the trade. Okay. So here on the order form, I could get in, to set up a trailing stop, you need to get in at least the easiest way is to get into the trade first. And then you would use a sell order, and it would be here's a trailing stop by a dollar amount or a trailing stop by a percentage. Okay. Now we're going to go through some examples of these in the next class. So I want to kind of just go over the explanation of them first, and then we'll show you some different ways you can use them. All right. And hopefully I can find a good, I was trying to find a good virtual platform that I could go place some of these virtual trades and show you how to use those orders so you can practice some of those orders too. All right. That's all I have for now. We'll see you Monday. Remember Monday for the next market update and next training, and we'll have more training on these order types. Thanks, everyone. Have a good weekend. Bye now.